Most of us are taught a pretty simple way to build wealth, right? Work hard, save your money, and stay away from debt. But what if that's all wrong? What if the real key is to embrace the very thing we're all told to fear? Today, we're digging into two completely different playbooks for money. One of them has made its author a self-proclaimed billionaire and also a huge source of controversy. So get this, that number, $1.2 billion. That is the personal debt claimed by Robert Kiyosaki, the author of the mega bestseller Rich Dad, Poor Dad. But here's the real kicker. He's not sweating it. In fact, he's actually proud of it. So how is it possible that a personal finance guru can call himself a billionaire while owing over $1 billion? And this quote, wow, this quote pretty much says it all. For Kiyosaki, having a ton of debt isn't a weakness, it's a weapon. It's a bold, kind of shocking statement that turns everything we think we know about money completely upside down. To really get how he thinks, we've got to break it all down. All right, so here's our game plan. We're going to start with the traditional way of looking at wealth. Then we'll dive into Kiyosaki's totally different ideas about debt and assets. We'll look at his famous Cashflow Quadrant, sort through all the heavy criticism against him, and then at the end, we'll put the two philosophies right next to each other so you can see which one really clicks for you. Okay, first things first. Let's set the stage with the conventional path to building wealth. The one you probably heard about from your parents or maybe even in school. It all boils down to a pretty simple, time-tested formula. And the core idea here is something called net worth. It's basically the scorecard for your financial life. You take all the stuff you own that has value, like your savings, your retirement accounts, stocks, your house. Those are your assets. And you subtract everything you owe, like a mortgage, a car loan, credit card debt. Those are your liabilities. Whatever's left, that's your net worth. That's your wealth. Let's make this a little more real. Take a look at Anthony's balance sheet. His assets, you see his 401k and car, add up to $46,500. Then his liabilities, his car loan and student debt are $22,500. So you do the math, and he's left with a net worth of $24,000. In this world, the goal is simple. Get that bottom number to go up. Grow your assets, shrink your liabilities. It's the slow, steady, and secure way to do things. Okay. Now I want you to take that fundamental equation we just talked about, because we're entering a totally different universe of thinking. Robert Kiyosaki looks at that equation and basically redefines the most important words in it. And this is where the two worlds just completely collide. Traditionally, an asset is just something valuable you own. But Kiyosaki, he throws that whole idea out the window. For him, it is all about cash flow. Simple as that. An asset puts money in your pocket. A liability takes money out. And this leads to his most famous and maybe most controversial claim. Your family home is not an asset. Why? Because you're paying a mortgage, taxes, insurance, repairs. It's taking money out of your pocket every month. He argues it's actually your biggest liability. So wait a minute. If your house is a liability, how in the world are you supposed to build wealth? Well, for Kiyosaki, the answer is another pretty wild idea. You have to learn to love debt. Well, the right kind of debt anyway. This idea is really the core of his whole philosophy. He calls it good debt. It's when you borrow money to buy an asset that actually makes you more money than the debt costs. So think about it like this. You get a loan to buy a rental property. If the rent you collect each month covers the mortgage, the taxes, the upkeep, and still leaves you with some cash profit, then that loan is good debt. You're literally using the bank's money to make yourself richer. And this way of thinking also explains why he's not a fan of saving cash, at all. He argues that ever since the US dollar stopped being backed by gold back in 1971, it's just constantly losing value. So instead of hoarding dollars in a bank account, he turns his earnings into physical things, like gold and silver. And when he wants to buy an income-producing asset, he'd rather use debt to do it. So how does this all fit together in a bigger picture? Well, Kiyosaki has this famous framework he created to help organize these ideas. It's a way of looking at the world based on how you make your money. He calls it the Cashflow Quadrant. See, on the left side, you've got E for employee and S for self-employed. This is where most people live. You're trading your time directly for money. If you don't work, you don't get paid. But on the right side, you've got B for business owner, someone who builds a system that makes money, and I for investor, someone who uses their money to make even more money. The whole goal, according to Kiyosaki, is to move from the left side of this quadrant over to the right. And the big idea here is really simple. Kiyosaki says that true financial freedom is only possible on the right side of the quadrant. It's about shifting from working for your money to having your money and your systems work for you. It all sounds pretty inspiring, right? A clear path to wealth. But this is where the story takes a very, very sharp turn. Because a lot of people are convinced that the entire foundation of his philosophy is built on a lie. I mean, the whole book, his whole brand, is based on these powerful lessons he supposedly learned from his best friend's rich dad. But for years, investigators and journalists have been asking one giant question. Did Rich Dad ever actually exist? And the criticisms are pretty severe. First, many people claim that the Rich Dad character is a complete fabrication, just a clever marketing story. Investigators also point out that there's really no public evidence of Kiyosaki's massive real estate empire before his book was already a huge bestseller. On top of that, critics say his advice is often way too vague, and sometimes it's straight up dangerous, unethical, or even illegal, like hinting at using insider information. Financial writer John T. Reed, who did one of the most in-depth investigations into Kiyosaki's claims, really doesn't pull any punches. He calls the book one of the dumbest financial advice books he's ever read, saying it's filled with bad, wrong, and even dangerous advice with almost nothing good in it. Okay, but that's a pretty harsh take. Not everybody sees it that way. Other people, like the white coat investor, have a more balanced view. The argument is, hey, even if the story is made up and some of the advice is sketchy, the book isn't worthless. It can get people thinking differently about money. It introduces concepts like the Cashflow Quadrant, and it pushes an entrepreneurial mindset. The advice here is to treat it like a buffet. Take the ideas you find useful and just leave the rest behind. So after all that, where does this leave us? Well, we've looked at two totally opposite schools of thought on how to build wealth. One is all about steady, secure growth. The other is about leverage, cash flow, and taking calculated risks. Let's just put them side by side one last time. For conventional wisdom, debt is a liability you want to get rid of. For the Rich Dad philosophy, it's a tool you can use. One says your home is your biggest asset, the other says it's your biggest liability. It's the difference between a path of budgeting, saving, and investing over the long haul versus a path of buying assets that produce cash and often using other people's money to do it. Look, at the end of the day, there's no single right answer here. One path prioritizes security and slow, steady growth by minimizing risk. The other path embraces risk for the potential of much faster, bigger returns. The path you choose really just depends on your own goals, how much risk you're comfortable with, and ultimately, the kind of financial story you want to write for yourself. The only truly wrong choice is not thinking about it at all.